And you can clearly see that over the last 100, 200 plus years, humanity has become incredibly productive, right? In 1930, one American farmer could feed 4 people. By the 2010s, one farmer was feeding 155 people. Yet on the other hand, these consumer goods denominated in dollars have only become more expensive, especially over the last 100 plus years, if you look out on that long of a time horizon. So it's kind of like two contrasting, variables going in the different direction. We're becoming a lot more productive, yet things are becoming more expensive denominated in dollars.
Hey everyone, and welcome back to the Bitcoin Magazine podcast. I'm your host, Spencer Nichols, and today we're joined by Joe Burnett. Joe has been a strong voice in the Bitcoin space for a long time, and he is really focused on highlighting the overarching fundamentals that drive Bitcoin, as well as the macro backdrop that has made the Bitcoin investment thesis so potent. Joe currently serves as a senior product marketing manager at Unchained, and previously was the product manager at Blockware Solutions. And today we're going to sit down with Joe to discuss his recent report titled Your Wealth is Melting, which gives a high-level view of what is driving Bitcoin, as well as comparing Bitcoin to other financial assets to try to make the case that Bitcoin is the sole solution to the debasement of currency and the impact that has on investments. All that out of the way, Joe, looking forward to speaking with you today. It's been a minute since we had you on the Bitcoin Magazine podcast, but looking forward to jumping in. How are you?
Yeah, thanks, Spencer. Glad to be here. And I enjoyed the Twitter space that we did in the past, so excited to do this again.
Awesome. Yeah. And I guess just to get right to the point here, you did write this report, Your Wealth is Melting. And I want to identify to start, who is the your in this case? Whose wealth is doing the melting?
Yeah, it's a great question. So yeah, we published this report, and the target audience of this report is effectively anyone that holds a significant portion of their wealth outside of Bitcoin. Because I think Bitcoin is money. It's the best form of money. And it really completely changes our relationship with the concept of wealth. Bitcoin is unprintable money. It's money that doesn't melt. Saylor calls it thermodynamically sound money, money without a leak. And I think this is a really big deal for anyone that holds wealth, which effectively should be every single person in the world, whether that's $1 or $1 billion or $100 billion. And I think it's a really big idea. And when you're holding wealth and you're trying to save wealth into the future, the long-term future, you want to make sure that your wealth doesn't have a leak. And I think 99.9% of the world hasn't quite recognized that their wealth is actually leaking. And we've now discovered this new monetary tool that doesn't leak or doesn't melt. So effectively, it's anyone that holds wealth outside of Bitcoin.
Yeah, thanks for breaking that down a little bit. And I want to dive a little bit deeper into, obviously you mentioned it's anyone who does not hold Bitcoin has this kind of leaky store of value. But where do you see the majority of wealth concentrated today? What assets do you think are leaking, and what is the concentration of those assets in people's portfolios?
Yeah, absolutely. So I can dive into specific assets that people hold their wealth in, and kind of explain how maybe unintuitively each one of these traditional assets is actually leaking. First, I kind of want to backtrack a split second and kind of explain why I wrote this, I guess. First, I think a lot of people view Bitcoin as this speculative bet, this lottery ticket that, no one really knows what's going to happen with, and we don't know where the future of Bitcoin really is. But like I said earlier, Bitcoin is just a better form of money. And so you should start thinking about Bitcoin as money. And what that means is actually denominating your net worth or your assets in Bitcoin. And I think a lot of people are just kind of assuming that Bitcoin is this lottery ticket, this speculative bet. But if Bitcoin has superior monetary properties, because it's immutably scarce, portable, durable, divisible, and fungible, then it's just money. And the best way to measure your wealth or evaluate your portfolio is by using Bitcoin as a unit of account and seeing, hey, are the investments or these traditional assets that I'm holding, are they actually performing well denominated in this money that can't be printed. So if we go back and like start to look at what are these traditional assets that everyone's holding today, and why are they leaking, maybe we can start with the US dollar, right? Everyone thinks of the US dollar as, effectively the world reserve currency today. But what is actually the US dollar? Well, it's a basket of consumer goods. It's a unit of account that's tied to a basket of consumer goods. And this unit of account is debasing at roughly 2% or targeted towards 2% against this basket of consumer goods every year. And on top of that, these consumer goods that it's tied to are actually something that we can produce very easily, right? Like China, you can, factories in China can manufacture, toothpaste or whatnot cheaper and cheaper in a more efficient manner every year. Energy is the same way. We get better and faster at producing more energy. Even, basic commodities like lumber or whatnot, we get better and more efficient at producing these things. Yet we're actually tying the dollar to these things, and these things are getting more and more abundant. So it's kind of like a double loss where you're tying the dollar to these very basic consumer goods, and then the dollar is also losing value against these basic consumer goods. So the dollar is obviously a really not great store of value. I think a lot of wealthy people already recognize this, and that's what leads them to actually go into more of the other more traditional long-term savings assets. And now we can kind of dive into those. Second one might be bonds. So what is a bond? Well, it's a promise for a fixed amount of future dollars, and which I just explained, future or dollars are just, this basket of consumer goods that's already debasing. Now, a bond is this promise for future dollars in the future, and what that has is it gives you a amount of yield that you can earn for putting your dollars into this bond asset and waiting for to receive the dollars in the future. But this added yield that you have when you invest in bonds, it comes with a risk, right? So there's default risk, and there's also inflation risk. If you're lending to a government like the US government, maybe there's very little default risk, but there's potentially inflation risk, as the government might pay you back in printed dollars or devalue dollars at the very least. And obviously there's corporate bonds and mortgage-backed securities and all other sorts of bonds to where, yes, there's yield, but there's also a risk that people don't pay their mortgage, or that the company that you lend to defaults on the bond or whatever else. So there's risk with bonds as well. Gold, this archaic yellow rock that's now at $15 trillion roughly total market cap. Well, they're still melting and leaking with gold. And in stocks, it's competition that's going out there and debasing your future cash flows. Well, in gold, it's entrepreneurs going out and mining more gold in a more cheap and efficient manner. And as technology gets better and as humanity continues to advance, we figure out more innovative ways to mine gold that weren't possible before. Real estate is very similar to gold in the sense that, okay, we have, $300 trillion worth of wealth in real estate, but there's ways that real estate melts as well, right? We have 50% of the Earth's land remains relatively untouched by humans. We have islands off the coast of Dubai, which is, where it's Palm Jumeirah, which is an artificial island that has 10,000 residents. And we can also build up too, right? So there's the Burj Khalifa, which is the tallest building in the world. It's at 164 floors. So we're able to build more real estate, debase the supply of real estate. And on top of that, real estate has property taxes. So there's carrying costs when it comes to holding real estate. If you have $1 million worth of real estate and you pay 1% every year to just say you continue owning that real estate, at the end of the day, that's a leak, or your real estate is melting over time. And so on top of that, you also have maintenance, right? Like real estate at the end of the day is just lumber, plastic, and a bunch of other pieces put together, steel as well. And this stuff actually, gets old. It needs repairing. It gets outdated. It gets out of style. So there's a lot of leakage when it comes to all of these traditional assets. And Bitcoin, on the other hand, is this one asset that doesn't leak. It doesn't melt. No matter how much time or energy is poured into mining more Bitcoin, there will only ever be 21 million Bitcoin.
So, Joe, one of the things that you do in this report that I really like is you basically unpack different technologies in the production of different commodities, and you really contextualize how technology is impacting this process of increasing the supply of those aforementioned assets. And in all of these examples you provide, whether that's the production of oil or the production of lumber or data transmission over time, what we see is kind of this like hockey stick graph up and to the right. In your report, you really unpack why this matters for people that are trying to store their wealth in things that are, of course, not Bitcoin. But could you unpack this a little bit more for us? Like, what is kind of the landscape of technological development, and how is this really impacting folks that are trying to, I guess, keep up with or outpace inflation in the long term?
Yeah. So there's this, like you mentioned, there's this section in the report titled The Acceleration of Production. And it goes through farming, data storage, oil, and lumber, which are all core components of the CPI. And again, the dollar is a unit of account that's directly tied to these, consumer goods, whether it's farming, data storage, oil, or lumber. And you can clearly see that over the last, 100, 200 plus years, humanity has become incredibly productive, right? In 1930, one American farmer could feed 4 people. By the 2010s, one farmer was feeding 155 people. And that's just one example of, the 4 different sections. But it's something that I think intuitively a lot of people know and understand. They're like, oh, yes, of course, we become a lot more productive at producing these basic consumer goods. Yet on the other hand, these consumer goods denominated in dollars have only become more expensive, especially over the last 100 plus years, if you look out on that long of a time horizon. So it's kind of like two contrasting, variables going in the different direction. We're becoming a lot more productive, yet things are becoming more expensive denominated in dollars. Yeah, this shouldn't be a surprise because, like I mentioned before, the whole point of the dollar is to be tied to a basket of these basic consumer goods and also debase against these basic consumer goods. So despite them becoming more abundant and humanity becoming more productive, it's still getting more expensive to buy these goods. And again, I think a lot of people recognize both of those points, but I think this can be tied to the even traditional assets that we see today, like real estate or gold. We're able to go out there and mine more gold. There's a chart in the report that shows the annual gold production as well, and it's going exponential despite the fact that gold is, a relatively scarce resource on Earth. We're still able to make more of it over time. And I think the same thing is happening with all traditional asset classes. Real estate, we're able to build more buildings. We're actually building up, right? Like we built a massive building that's 100 something stories high, and we're even building artificial islands off the coast of Dubai that have 100 or 10,000 plus residents. So we're able to debase or slowly debase the wealth that's stored in these traditional assets, and the whole point of the acceleration of production section is to just show that this is happening. It's been happening. It's happening even for traditional assets as well.
Yeah, and hearing you talk about that, it reminds me a lot of a book by an author named Jeremy Rifkin titled The Third Industrial Revolution. And what he talks about essentially is a similar idea of over time, we are trying to drive the marginal cost of production of goods as close to zero as possible. And that's kind of the overarching trend of technology. And seeing that in your report, I'm like, wow, like this really seems like we're reaching kind of an inflection point. And of course, everyone is talking about AI these days, but I think in general, it's hard to deny that there really is kind of these really sharp feedback loops that are all feeding off one another and really ramping up the progress of technology. So like in your eyes, like how large of a problem is this today for somebody, say, who is trying to store their wealth in gold, versus 10 years ago? And where do you see this ultimately headed?
Yeah, it's a great question. I definitely think it's undeniable that technology is accelerating faster and faster than ever before, right? We learned to fly, and then we soon landed on the moon. We invented the telegraph, and then we soon created the internet. And that's all just been happening in the last, 250 plus years. And in the grand scheme of, humans being around for thousands of years, that's a pretty rapid advancement that we've had, and things are accelerating faster and faster with AI. And so, yeah, I think just like consumer goods that are getting exponentially cheaper, or at least exponentially cheaper in real terms, or in how more efficiently we can produce these basic consumer goods, the same concept of like efficient markets and technology deflation applies to these traditional assets, whether that's gold, real estate, stocks, or bonds, or whatnot. And I think that's a really big deal. And I think the fact that it's accelerating, like you hear Jeff Booth has talked about, folding a piece of paper 50 or so something times. And if you do that, if you ask a normal person that, they're like, well, I don't know, it'd be like an inch tall or a couple inches tall, but you're like, actually it would go to the moon or something around those lines. And it's true, because you're doubling, it's exponential growth. You're doubling the size of the paper, the width of the paper every single time. And so that's what's happening with technology, and it's accelerating faster and faster and faster. And it doesn't just affect basic consumer goods. It affects the traditional assets that you're actually holding your wealth in today. And so, yeah, I think it's a really big deal for anyone that's holding wealth outside of Bitcoin, because we now have this thing called Bitcoin, which is like cryptographically protected to only have 21 million Bitcoins. And you can run the code yourself. You can set that rule, and you can enforce it. And that's a really big deal that we've never had before compared to every other traditional asset that exists today.
Yeah, absolutely. And I think it also highlights how this increasing pace of innovation is making storing one's wealth in any equity long-term increasingly more difficult. It fundamentally requires them to become a trader in some sense, where, say, before the advent of Netflix, if you were like, I'm going blockbuster for the long term, I think everyone's going to watch videos forever, you would ultimately end up, being, Blockbuster was usurped by Netflix and by streaming a video. And I think we see that across so many industries where there is nothing that we can be certain will stand the test of time. And that's, I think, what really grabs people about Bitcoin is, how do you improve upon absolute scarcity? To quote someone who we all are familiar with, there is no second best to absolute scarcity, that there is really no improvement that you can make. And now I kind of want to address a little bit more of like, this Bitcoin being the deep freeze that your portfolio desperately needs, as you describe it in this report. And I want to start from the top here. Like, I think what you do in your report is you address a lot of misconceptions, drawing from the work of people like Parker Lewis, who's done a fantastic job trying to debunk some of the FUD, or I guess address people's objections to considering Bitcoin seriously. So in your experience working with Unchained, for example, are there any misconceptions or difficulties that people have that you thought it was really important to address in trying to explicate Bitcoin?
Yeah. So speaking broadly, I think, and I mentioned this a little bit at the beginning as to why I wrote this report, I think a lot of people view Bitcoin as this like speculative asset or this lottery ticket that they don't fully understand. They think maybe one day it'll be worth millions of dollars, and maybe one day it'll be worth $0. But I think that's the very wrong way to think about Bitcoin. I think Bitcoin is the one asset without counterparty risk and without dilution risk. And it has these unique monetary properties because it's portable, durable, divisible, scarce, and fungible. And that just makes Bitcoin good money. And good money doesn't need cash flows. It doesn't need to be useful for any other purpose other than holding it and trading it with someone else. Like, that's what you do with money. You save it and then you trade it with someone else in the future. And people want the most saleable, most marketable good. So I think what stops a lot of people, or what a lot of people get hung up on, is they don't fully understand what money is to begin with. And then they try to put Bitcoin into the box of their other traditional assets, whether that's real estate, stocks, bonds, or whatnot. And it's this weird asset that doesn't have any native cash flow to it. And people get really stuck on that. But when you realize that Bitcoin is actually just good money, in fact, it's the best money, and society is like actively converging on the one best money, and you realize that all of these other assets that people hold today are able to be debased or devalued, at least in it's possible to debase or devalue them, even if it occurs very slowly, then even if that's true, or if that is true, which I believe it is, then you want to cash out of those assets that are debasing, even if they're debasing at a very slow rate, to the one monetary tool that doesn't debase and doesn't get devalued. And so I think that's the core of the argument, is like, even if you hold your wealth in real estate and we're able to create houses very slow, or there's a very slow leak of property tax every year that you're paying for your real estate, well, the wealth that you're storing in real estate is still melting, even if it's occurring very slow. And so you want to be the person that cashes out of your real estate and buys the best money that doesn't get debased before everybody else. So I think what gets people hung up on is the fact that Bitcoin is just money, and they haven't quite considered what exactly money is yet.
Yeah, and that example that you just offered of real estate kind of has me thinking, if Bitcoin is going to monetize other assets that carry a monetary premium like real estate, from my understanding, would necessarily demonetize to some extent. What relative risks do you see between a Bitcoin compared to other monetized goods? I mean, I guess, starting from the bottom, what do you think is kind of the first one to go? I mean, I think a lot of people look at gold as being a prime candidate for demonetization. It's obviously very comparable to Bitcoin in terms of trying to, I guess, overtly be a money. But how do you think about what the relative risks are of those non-Bitcoin assets?
Yeah, so I think bonds and gold are probably two asset classes that would be very likely to be demonetized, so to speak, as Bitcoin continues growing in adoption and continues outperforming every other traditional asset class like it has for the last 15 years. And I think the reason that this is happening and will continue to happen is bonds. Well, what are bonds? Bonds are promises for future dollars. Dollars are designed to debase against basic consumer goods, like I mentioned, and these bonds are promises for future dollars that are well out into the future, right? If you have a 10-year bond or 20-year bond or a 30-year bond, those dollars are well out there into the future, and humanity is probably going to become extremely productive in the next 30 years, on top of the fact that, we're probably going to be spending, or the government is probably going to be spending a ton of money devaluing the dollar on top of just the natural technology deflation that would be occurring in basic consumer goods. So I think there's very little incentive to hold any long duration bonds that have any sort of like fixed interest rate. And I think that's become pretty obvious over the last 3 or so years. And I think it'll probably become extremely obvious over the next 10 years. And then gold, I think, is another key asset that will clearly get demonetized by Bitcoin. I think the whole purpose of money is for humanity in the market to converge on one best tool for savings and trade. Like, that's the whole purpose. It solves the double coincidence of once, where if I'm selling apples and you're selling oranges, if you need apples, then I can give you my apples like right now, but you may not need apples right now, and I may not need oranges right now. So we need to find one common tool that we can converge on that's durable, divisible, portable, and fungible and scarce, that we can trade in the meantime, use that tool as savings in the meantime, and then ultimately use that tool to trade for whatever we want in the future. And that's the whole point of money. We converge on one best tool to do that. And if you happen to pick the second best tool to do that, well, then there's a risk that other people holding the second best tool will cash out of the second best tool and go to the first best tool, because again, the whole point of money is to converge on one best tool for savings and trade. And so since gold is now clearly not the best tool, then there's $15 trillion worth of wealth stuck in gold that should exit as fast as possible. And I would argue that they should exit as fast as possible into the first best tool, which I think very clearly is now Bitcoin if you just evaluate it on its monetary properties compared to gold. So yeah, I think bonds and gold are clearly two traditional asset classes that will be demonetized by Bitcoin.
Yeah, and when you're talking to folks, like clients of Unchained, I assume they may not operate in the Bitcoin space every day of their lives like us, but what is the reasoning behind why some of these net new people are investing in Bitcoin? I think a lot of the discourse has changed post ETF approval in the United States. So are they looking at this in terms of Bitcoin versus bonds? understanding the negative real return of bonds? Are they just looking at Bitcoin as a speculative asset? Essentially, I'm just curious, like, what is kind of like the temperature check on kind of these flows into Bitcoin that you're seeing?
Yeah, it's a great question. I think of Bitcoin adoption as occurring in phases. And I tend to think of Unchained clients specifically, mostly being like the more sophisticated, like they understand Bitcoin in a better way than most people probably in the world understand Bitcoin. I view things like FT, BlockFi, Coinbase, and even the new spot Bitcoin ETFs as very like top of funnel marketing for real Bitcoin, where it's like, okay, if you want to get exposure to Bitcoin, yes, you can buy the BlackRock ETF, or yes, you can buy Bitcoin on FTX and hold it there, or Coinbase or whatever other centralized exchange. And I think that's good, right? Like when you're first learning about Bitcoin, you just want to get exposure to NGU technology, number go up technology, right? That's what some people refer to Bitcoin as. And you don't necessarily care how you get exposure to it. You just want exposure in the cheapest, simplest, easiest way possible. And that tends to be, something like BlackRock or Coinbase, as they're spending, millions and millions of dollars marketing Bitcoin and their new Bitcoin products that are, you can buy on E-Trade and Fidelity. But I think once you start to get exposure to, this number go up technology, and the number actually starts going up for you personally, and it becomes a larger and larger portion of your net worth, then you're like, okay, I want to make sure I'm holding this Bitcoin in the best, most secure way possible. And I want to be confident about that. I want to not think that, oh my gosh, what if I am holding Bitcoin with the next FTX or the next BlockFi? Like, I want to make sure that whoever I'm holding my Bitcoin with can't lose my Bitcoin. Or maybe, you can use something like Unchained, where you have two keys yourself. Unchained holds a backup key, and then and that way you can't actually lose your Bitcoin. There's no single point of failure for your Bitcoin. And Unchained, if they disappeared, then you still have access to your Bitcoin. You can load it up into any open source wallet software like Sparrow and use your two keys that you have to sign your transactions and move your Bitcoin to another wallet or another vault. So I think of Unchained clients as typically like more sophisticated Bitcoin holders. They could be older Bitcoin holders, as in like early adopters that have a significant amount of Bitcoin. They could also be actually older, wealthier people that are like, hey, I have, this $5 million, $10 million more retirement portfolio, or I've started a business and now I'm retired, but I want to get exposure to Bitcoin and I want to do it the right way. I don't want to have to trust a third party to hold all of my Bitcoin for them. I recognize that there's value in actually being able to take self-custody of my Bitcoin, but I'm a little too hesitant to do that entirely by myself. And Unchained is kind of like this perfect middle ground to where you have someone to help you out if you need it, but you still remain in complete control over your Bitcoin. So yeah, I think Unchained investors, they're kind of or not Unchained investors, but Unchained users or Unchained clients. They're kind of a wide variety of people. It's typically wealthier people, whether it's early Bitcoiners or, high net worth individuals, but it's people that want to hold a lot of Bitcoin and they want to hold it in the most secure way possible.
Yeah, that makes a lot of sense. And on that note of kind of like Coinbase and say BlackRock and Fidelity being kind of this top of funnel, I almost think that Sam Bankman-Fried in some ways was the very, very top of the funnel for so many people. So I suppose some of us have him to thank, others not so much. But I think it really did highlight the importance of using this asset in the correct and secure way. This really was not an option ever. You can't multi-sig gold, for instance. There was kind of these certificates of deposit that you would use. You would trust a custodian. That kind of became normalized. You can't self-custody really anything other than Bitcoin holding your private key, or in a multi-sig setup, ideally to remove those single points of failure. And so I think it's fascinating, and I do want to kind of get your take on how you see multi-sig being kind of the foundation of financial services built on a Bitcoin standard. But before we get there, I do want to just take one more second to talk about kind of the economics behind Bitcoin and what you think it might do for financial markets and the economy. And There's, again, you quote Parker Lewis in your report, and he wrote about this in Bitcoin is the Great Definancialization, where he basically talks about what it means to have a financialized economy in comparison to a definancialized economy. So I just want to, I guess, pick your brain on how do you think an economy operating with Bitcoin as the, primary store of value or unit of account would differ from today's markets and everything we've seen, whether that's, the risks that we saw in 2008 or, risks that have yet to materialize in the future. But just curious your take on what a new economy built using Bitcoin would mean.
Yeah, I mean, I think it would be very different from what we have today. I think today, because of the way that our money works, we're forced to save in assets that we shouldn't be saving. Like, we're saving in real estate, which is leaking. We're saving in gold, which is leaking. We're saving in big tech, which is also leaking. We're saving in all these assets that's leaking and melting. And Bitcoin now is a monetary asset that doesn't leak or it doesn't melt. I think that has big implications because now we won't have to hoard real estate up to unlivable prices where the price of a house is 7x the median income in the United States or in Canada or in Australia. We won't be hoarding, big tech monopolies and funding, their exponential growth of buying out all of these early stage companies and just kind of being like these monolith entities that can just crush anything that tries to compete with them. I think it's going to restore free markets and capitalism more because there won't be these large entities, whether it's big government or massively big government or big, large S&P 500 companies that are able to borrow money at some of the cheapest interest rates in the world. And effectively, if you're borrowing money at cheap fixed interest rates for long duration, you're effectively very close to the money printer. And you're obviously going to be, especially if you're a company, you're going to be using that money to buy out, smaller companies at, valuations that seem high to them. But, in a few years from now, they probably will seem to be even higher. And, the company that used borrowed money to buy these smaller companies, they did very well. And then the smaller companies get left with no assets or they can't compete with the larger companies anymore. And so I think it changes a lot of things in a big way. From an individual's perspective, I think things like passive index funds or the quote unquote perfectly diversified portfolio would completely change on a Bitcoin standard. I think there's no need to hold these large passive index funds that literally hold trillions and trillions of dollars today. I think that can effectively be replaced by holding cold storage Bitcoin, because what you're doing when you're buying, SPY or any sort of large passive index fund is you're just trying to save for the future in the best risk adjusted manner. And I think Bitcoin now solves that purpose for the reasons that I previously stated. And I think that changes everything in a big way. So yeah, I think from an individual's perspective, your typical portfolio would just be a lot of cold storage Bitcoin. And then if you're wealthy, maybe you'll do some moral investing, something that you feel good in or something, or you'll try to create a future that you want to create just because you have excess savings. But if you want to save for the future in the best risk adjusted manner and you don't happen to see any sort of great attractive investment at the moment, you can just save Bitcoin. And with the natural evolution of technology deflation that's only accelerating, like we mentioned, your Bitcoin will just be worth more and more in terms of, basic consumer goods and even, houses and basic living conditions. You'll be able to buy a lot more with your Bitcoin and you won't be overly complicated with a bunch of complex investing jargon.
Yeah, really well said. And I think too, it's just interesting to think about in a fiat currency-based economy, you essentially have holders of fiat currency that are being debased, and that debasement is reducing the real cost to pay back debt. And so large corporations can pledge their assets as collateral, they can take on debt, and then that cost of debt gets reduced over time at the cost of people that are trying to actually save. And so it creates these really perverse incentives. And I do kind of share your perspective that it might reduce, I guess, what we could even call centralization in our economy. It creates kind of more of a spreading out. At least that would be my hope. remains to be seen, I think, in the context of technology, if that will, concentrate wealth, as I think it arguably has. But it also will reduce the cost of living in some ways. So there is trade-offs there, but I do agree with your perspective. And I guess I also just want to take a moment to discuss a little bit of like the current macro backdrop. I know you've mentioned the U.S. deficit, increased spending going forward, and kind of the dynamics there. A traditional bond investor might say to me, hey, I'm purchasing a bond with X yield. That yield has, our future inflation expectations priced in. I should, be net, neutral as far as the return I can expect. But I think we've seen the bond market get inflation wrong quite frequently, especially since 2020. And so I want to take a moment to just unpack where we are in terms of the bond market and its evolution, and where you see things going in the context of U.S. interest expense, how much spending we're going to take on in the future, and what this means for bondholders. Because I think in today's environment, people are kind of like looking over their shoulder if they're holding bonds. They're like, what the heck is going on? I thought this was supposed to be the risk-free asset. So if you could just drive that home for us a little bit, that'd be great.
Yeah. A lot of people refer to like T-bills or treasury bonds as like the risk-free rate of return. And I think that that's actually like correct to some extent, right? Like the U.S. Treasury is not going to default on their payments when you borrow money from them. Like they're going to, at the worst case, they're just going to print the money and give you the money back. What's not risk-free is like the real return, right? Like we don't know what inflation is going to be. We don't know if there was actually going to be a better way to preserve your wealth outside of the dollar system than current that than people know of, right? So like, yes, like maybe your return on your 10-year treasury will be decent. Maybe it will buy slightly more consumer goods 10 years from now, because technology is continuing to advance, and because things are getting cheaper over time in real terms, and because maybe like the government doesn't run or somehow doesn't run a crazy deficit, or maybe technology deflation is just that advanced and that effective. But maybe at the same time, people are looking to store their wealth from this massive, from all these technology advancements that's actually making us more wealthy. And maybe people are not going to choose to store their wealth in treasury bonds or T-bills because they recognize that, hey, like these are designed to debase over the long run. Maybe they're going to store wealth in the NASDAQ or the S&P 500. And increasingly more people, I think, are going to choose to store wealth in Bitcoin. So yeah, like I think bonds specifically, I think the dollar, again, is just designed to debase over time. It's designed to debase against these basic consumer goods, and for the production of these consumer goods is accelerating over time. So it's like a losing bet. It's in a way, it's kind of like a bet against humanity. And that's typically true of bonds. Like bonds are like the bearish conservative case, where like historically, if stocks fall a lot, then or at least like before 2020, if stocks fall a lot, then Fed will lower rates and bonds will perform well. But now it's like we're living in a world where the government is just running massive deficits. And if stocks happen to fall a lot, then yes, maybe the Fed will lower rates, but also at the same time, like they're going to print a bunch of money just to keep the economy going. And so maybe your long-term bonds like don't perform very well because the long-term expectation of future rates is significantly higher, because people think that inflation is going to be higher in the future, and despite technology deflation that might be occurring, or just these massive government deficits that are going to continue to keep inflation hot, whether that's in real terms or like nominal terms. But yeah, I think again, the dollar is designed to debase, so I think bonds will probably not be the safe haven asset that has historically somewhat been the case, from like 1980 to 2020. It was the case, but now we're kind of in a different era, and there's a much better monetary tool to be held.
Yeah, and I have a follow-up question on that, and this is just kind of my own personal interest here. People talk about the risk-free rate of return, and they use that to calculate a discount rate. You add that to the risk premium of a given investment. You look at the projected future cash flows and discount those back to the present. And you mentioned that as inflation runs hot, you would expect bond yields to increase to account for that. And so when I hear that, all I hear in my head is this means time preference is going up. It means our future cash flows are becoming less valuable in today's terms. And I just think about what that would mean on a Bitcoin standard. Like, how would you think about how an economy would operate on a discount rate using Bitcoin rather than the yield on a U.S. government bond, for instance? Or is that even a non sequitur? Will we always use, the U.S. government bond as that risk-free rate?
Yeah, that's a great question. And it's fun to think about what will happen. I think like in the short to medium term, I don't expect the dollar to go away. I don't expect T-bills to go away. So I think that will probably continue to be like a good short-term reference for like a solid risk-free rate of return in dollars. And I think as long as the dollars don't like hyperinflate to crazy numbers, there's still probably some value in creating like this short-term unit of account that's tied to consumer goods, even if it's like slowly debasing away to zero. Like there may still be a reason to like hold a small portion of your net worth in dollars or in T-bills. And I think like that's what people do today, right? Like very wealthy people will hold, almost all of their wealth in real estate or public or private equities. And then they'll have like a small amount of dollars or cash just to like weather any crazy volatile storms that might occur due to, hyper financialization or the Fed deciding to raise interest rates or, the government running a massive deficit. So like there's probably, it seems somewhat likely that the dollar will persist for quite some time. After that occurs, and maybe we'll get to a stage where like Bitcoin is the world's best money and it's at full adoption and it's not super volatile and there's no reason to really hold this also not volatile thing that's debasing against basic consumer goods faster and faster over time. At that case, Nick Bhatia has done cool research in the past over like a Lightning reference rate. I don't know if like people are actually using that today or if people will be using that in the future, but I still would imagine there will be like a risk premium on any sort of investments that you buy, even under a Bitcoin standard, right? Like if you can hold Bitcoin, you can hold one Bitcoin for the next 10 years, and in real terms, that Bitcoin might continue going up very significantly over time. So you're going to be looking for an investment that does better than that, and it also accounts for like the risk of taking that investment and the volatility of that investment as well. So yeah, there's still always going to be like a risk premium on different assets. As far as like what will be the risk-free rate on a Bitcoin standard, maybe Nick Bhatia is very close with his like Lightning reference rate, but who knows? I think there's going to be like so many future unknowns when it comes to like the core foundation of like a Bitcoin financial system. And we're still like very far away from that. Like I think if we ever get to that point, Bitcoin will be worth a lot of wealth or a lot of houses today.
Yeah, well, I appreciate you entertaining the thought there. That's one that's crossed my mind frequently, but I'll have to brush up on Nick Bhatia's take. And in your report, you do quote Nick Bhatia here, and you say, or Nick rather says, Satoshi broke economics with digital scarcity. No supply response destroys every model. And I do think that really highlights, one, the gravity of the situation. And in the context that you just said, like we are still so early. And I think people are beginning to see that these traditional models, like you said, the 60-40 or kind of this, equities and real estate in conjunction with bonds, like those models are beginning to see cracks. We're seeing increased correlation between equities and bonds as well, which essentially defeats the purpose of that risk parity type approach. And I think in my mind, we're at the beginning of what I envision to be a better financial system, but also something that can be rather different in terms of how people manage their portfolios and their balance sheets. And I want to set you up here to talk about, your vision and the vision of Unchained as to how people can use Bitcoin native technology to have a, I guess, better risk management practice when it comes to capital, whether that's operational or allocation based. So like, when we talk about multi-sig, I think people can be like, first of all, if they're new to Bitcoin, they're going to be like, what's a multi-sig? Like, so maybe just kind of walk us through how this means of custodying Bitcoin can be used for, individuals and, corporations and even institutions, and kind of your vision there as it pertains to multi-sig.
Yeah, definitely. So yeah, like I mentioned before, I think a lot of people get into Bitcoin and they're like, I just want number to go up. I don't care about custody. And that makes sense because before Bitcoin, it's like you don't really think about how you want to custody your real estate, or you don't really think about how you want to custody your Nvidia stock, or you don't think about how you want to custody your US dollars even, right? Like as long as your bank account is FDIC insured and you have that, comfort or assurance that the government is providing, then you're not too worried about who you pick as your bank and how they're storing your dollars, and if they're going to have a security breach, or if they're going to make, bad malinvestments with your money. You're just blindly trusting the system, which is fair, and it makes sense that there's really no need to stress about, which bank you choose per se. With Bitcoin, it's very different. There's no lender of last resort in Bitcoin. So if you pick the wrong custodian, which we've seen countless times, whether that's Mt. Gox, FTX, BlockFi, Celsius, so many others, you will actually lose your Bitcoin. There's not going to be anyone to help you recover your Bitcoin if your Bitcoin doesn't exist, or they lost it, or got hacked, or got stolen. And so you want to make sure that you're going to custody your Bitcoin and hold it in a secure way. And you want to make sure you can hold it for decades or generations or centuries. And I think Unchained is working to provide a product that enables you to actually hold Bitcoin for generations. And the way it works is Bitcoin multisig, where you have your Bitcoin stuck in this, or locked in this multisig vault, which is short for multi-signature, where multiple keys are required to unlock your Bitcoin. As an individual, you can have 2 keys that belong to your vault, and your vault can be opened and unlocked with those 2 keys. And with those 2 keys, you can send your Bitcoin. If you happen to lose one of your keys, or one of your keys gets stolen, then you only have 1 key remaining, but Unchained has a 3rd backup key that can be used in accordance with your first key or your second key, and then you can move the Bitcoin out of your vault. So it basically eliminates any single point of failure that can occur when holding your Bitcoin for decades, literally. So you can lose one of your keys, Unchained can completely disappear and go off the map. And as long as you still have both of your original keys, you can load your vault into an open source software like Sparrow Wallet or Unchained's Caravan, which is their open source wallet. And then you can access your Bitcoin with your 2 keys that you have, and then send your Bitcoin wherever you want. Whereas, contrasting that with FTX or, BlackRock ETF or whoever, those coins the private keys to those coins are held by Coinbase, they're held by FTX, they're held by who knows who in a black box, and you don't have access to the private keys. And so the beauty of Bitcoin is you can actually really hold your Bitcoin. Like you can have physical possession of your Bitcoin with no counterparty risk whatsoever. And Unchained, whether you're an individual or an enterprise or an institution, you can actually do this with confidence, and you can do it ensuring that there's no single point of failure with your Bitcoin.
Yeah, and I think it's so interesting to think about too, where you have like a 2 of 3 setup as you guys use in the Unchained vault, but there's also, you could go up to like even 6 of 6 if you really wanted to. But this does is it opens the door for different quorums necessary to be able to move Bitcoin. And this creates like inbuilt governance into these funds that, say, a corporation or institution would really need. And I find Drew Bensal, he's a co-founder of Unchained, I find his vision of Bitcoin needing a network of keys to be very influential. So I was wondering if you could comment on that. Like in the long term, how do you see, as Bitcoin increases in market cap, obviously larger and larger entities are going to get involved and potentially, not just hold, the piece of paper that says they own an ETF. What is kind of the vision that you and Unchained sees as this asset continues to mature?
Yeah, so the network of keys concept, I think, is quite fascinating, and I'm extremely bullish on it. I think there's like 2 key like target clients that I'm at least most passionate about right now. One is like the enterprise model, right? Like if you are a large corporation right now, you may be holding Bitcoin with Coinbase custody. Again, Coinbase custody might be a black box to you. Like maybe they're using multisig, maybe they're using MPC, but at the end of the day, it's a bunch of entities within Coinbase or people within Coinbase itself that are accessing your Bitcoin and control the keys to your Bitcoin. Now, with collaborative custody or a network of keys, you can have different key agents out in the world where each key agent has a key to your Bitcoin. So now Coinbase may have a key, or Bakkt may have a key, or Unchained may have a key, and you may have a key. And so now it's not just segregated or siloed in one individual custodian. You now have multiple key agents that, one can actually make a serious major mistake, and now all of your Bitcoin still remains perfectly safe because there's no single point of failure when it comes to building an Unchained vault. And so I think that's the future of like enterprise custody, where people don't rely on one company or one institution or one key agent to ensure that their coins are safe forever. A second, also interesting, use case of the network of keys is like RIAs, so registered investment advisors. This could be like the Peter Dunworth Bitcoin advisor type model, where, okay, as an individual, you recognize it's important to take self-custody, but you're scared to do this because it's quite intimidating, and you want someone to help you and walk you through it. Well, you can have a 2 of 3 multi-sig again, where again 2 keys are required to move your Bitcoin. You as a client can have 1 key. You can delegate 1 key to your investment advisor, or Peter Dunworth, or his group of people, or your other investment advisor. And then you can also have Unchained hold the 3rd key as well. So now you know that you have 1 key. You can see that your coins exist. You can like verify that you have access to that address that holds all of your Bitcoin currently. And then you know that your advisor cannot run off with your Bitcoin all by themselves because they only have 1 key. And then Unchained cannot run off with your Bitcoin all by themselves, or if they get hacked, because they have 1 key. And so it still requires 2 keys of the 3 keys to move your Bitcoin. And it kind of creates like a very secure way to where, again, there's no single point of failure when it comes to holding, your family's Bitcoin.
Yeah, absolutely. And I think for me, it's fascinating to think about how early we are in this adoption cycle. I think like people don't really understand that there is going to be this enterprise-based custodial arrangement, or I guess self-custodial in some sense, that I think is going to be a big conversation. I think, again, we're early. I think 4 years from now, this is going to be a serious conversation that a lot of people are having. So I want to try and wrap this up here. And I know in your report, you cite so many different Bitcoiners, whether that's Jeff Booth or Seyfedin Amous or Michael Saylor or Trace Mayer. For people that are beginning to understand Bitcoin and I guess move down that funnel as you described, who are some like inspirations or people that have been, helpful or informative to you as you've begun to try to unpack what this asset means?
Yeah, I think Jeff Booth has played a pretty key role in my understanding of Bitcoin and also my framing of this report. I think Jeff Booth in his book Price of Tomorrow did a great job of explaining like exponential growth and technology deflation. And I think the key idea behind the report, Your Wealth is Melting, was kind of applying this idea, this very correct idea and obvious idea of technology deflation to the world of traditional assets, whether that's stocks, real estate, gold, etc. And we're storing wealth in all of these things that were becoming easier and easier to produce over time. And I think that was like a key, unique insight that like I hadn't quite thought about before. And it's like, yes, of course, like we're going to be able to produce toothbrushes a lot faster than we're going to be able to produce houses. But at the end of the day, like a house is still just a bunch of wood and a bunch of basic plastic and steel put together. And like over time, we're going with AI, robotics, all sorts of new technologies that are compounding at a faster and faster rate. We're going to have, humanoid robots that can spin up a house or an apartment building in a rapid amount of time. And even if this occurs very slowly, you still want to cash out of your melting, leaking asset for the one asset that doesn't leak, which is Bitcoin. So yeah, I think Jeff Booth played a pretty key role in my understanding of Bitcoin and just kind of like technology deflation as a whole.
Yeah, absolutely. I can definitely see Jeff Booth's impact on how you think about and frame Bitcoin. And I agree. I think Jeff reading The Price of Tomorrow was like an aha moment for me in a lot of ways, coupled with everything else I learned about Bitcoin. But I think that, yeah, his understanding and experience with technology was very informative and persuasive to me. But for folks who have been listening and maybe something you said in this conversation resonated with them and they want to learn more about your perspective on Bitcoin as an asset, or just, how to secure your Bitcoin properly. Where can they connect with you, Joe?
Yeah. So you guys can find me on Twitter or X. My handle is at III Capital, or my name is Joe Burnett on X. I'm also on YouTube. You can search Joe Burnett 27 or Joe Burnett Bitcoin. I should probably pop up there. And then, if you want to actually read the report that we've been talking about, you can go to unchained.com/melting.
Fantastic. Yeah, we'll have that down in the show notes for all the listeners as well. Feel free to give it a read. It's pretty easily digestible, but pretty exhaustive as well. It essentially ties together all of these multifaceted perspectives on Bitcoin into a cohesive narrative in the context of other assets. So, Joe, really appreciate you taking the time today, man. Congrats on writing a great report. And I know Michael Saylor had this on stage at the recent Bitcoin for Corporations, citing your work and discussing real estate specifically. So kudos on that win as well.
Yeah, thanks, Spencer. Enjoyed catching up with you, and always great to chat. I enjoyed our Twitter space that we did a while back, so it was awesome to do this.
Yeah, fantastic, dude. Well, we will talk soon, I'm sure. Have a great rest of your day.
Cool. Thanks.